Hello and welcome to this lecture video. So this lecture video will cover adding or dropping a product line or a division or a segment. We will also discuss the make or buy decision. So as I say right over here, dropping a product line is a very significant decision. So in terms of a university setting, to give you a little bit of context, what we're talking about in terms of dropping a product line would be, for example, dropping a major. You know, if we had a major, Mary Washington used to have a major in dance a very long time ago, and they did decide to drop it. And so that would be an example of dropping a product line in the context of a university, to give you a little bit more of a real life example right there. The thing is about dropping a product line is that we have to think about the common fixed costs, okay? Common fixed costs are not incremental. All right, so what we're talking about right over here is, let's say that we have the library at Mary Washington. And let's say that the library allocates its costs out to Major 1, Major 2, and Major 3. Okay, so it allocates its costs out to these different majors on campus. And that would make sense in some contexts because the library is a support function, just like we talked about in some cost allocation videos. The library is a support function. It's a service department. It would make sense for it to allocate its costs out to different majors or different departments. We could even call them departments. I just said major. Different majors or different departments, perhaps based upon how many resources are checked out or how many magazine subscriptions or something like that, okay? Now what happens is if we drop Major 1, and let's look over here, the decision for dropping Major 1 is that if, just from a financial standpoint here, only from a financial standpoint, if we drop Major 1 and then the entire income of the entire university, the income of the entire university, if after we drop Major 1, the income of the entire university goes up from a purely financial standpoint, okay? I'm just saying purely, I'm not saying that we should do this. I'm just saying purely from a financial standpoint, that's something we want to look at. Purely from a financial standpoint, okay? The problem is that let's say the library has $10 and we have our $3.30 here, $3.30 here, $3.30 there, okay? Each major gets 1/3, okay? If we drop Major 1, what happens is that this 3.3 comes over there, so that this increases, and then this also increases. Okay, that's the problem. That now this is 5 and this is 5, because now these two share in this common cost. What we're saying is that the library may not reduce its costs, even though UMW would have lost a major. Okay, that's what we're saying. Okay, so if that's the case, and that's what we're assuming here in some of these problems, is that the library doesn't reduce its costs. It just shifts its costs to the remaining departments or the remaining majors. If that is the case, then this $10 of library costs is not a differential cost, because it would stay $10 whether or not we drop Major 1 or keep Major 1. It just gets shifted to other majors, other departments. If that's true, it's not a differential cost, as I was saying, which means it's not relevant to our decision. It would be irrelevant to our decision to drop Major 1 or keep Major 1. Okay? So that's what I'm saying right over here, that these common fixed costs are just spread among the remaining product lines. And so if that's the case, and that's what we're assuming for a lot of these problems, they are not relevant, okay? And again, getting back over here, the decision to drop a major. The decision to drop a major for a university is a significant decision. That's what I'm even saying over here. The decision to do this is not based upon only purely financial terms in the real world. There are a lot of other things that go into that. I'm only saying purely from a financial standpoint. If it's losing a lot of money, that's something we want to think about. Purely only from a financial standpoint. But It's a very significant decision. There's a lot of other things that go into that. Okay? So due to the declining popularity of digital watches, our company's digital watch line has not reported a profit for several years. So then what we have on the next page is we have an income statement that shows us exactly what's going on. So we have our digital watches income statement right over here. We have our sales of $500,000, lesser variable manufacturing costs, lesser variable shipping. Our commissions gives us total variable costs. Sales minus variable costs gives us contribution margin. Then we have our general factory overhead. We have the salary of our product line manager, depreciation of old equipment, advertising, and then rent. We have general and factory administrative expenses, and then we have our total fixed costs, and then we take our contribution margin minus our total fixed costs, and we're showing a loss right over here of $100,000. Now, because of this loss, digital watches, we're thinking about, well, maybe we shouldn't keep it anymore because it keeps losing money, purely from a financial standpoint. So when we look over here, in terms of the general factory overhead, we have one asterisk. Okay, that is an allocated common cost, just like the library example that I gave you. So this is going to be irrelevant because it's going to stick around whether or not we drop this digital watch line. It will just get shifted to other product lines. Same thing with general factory overhead. So why don't we do a second and say, look at the fixed costs and say which fixed costs are going to be relevant and which fixed costs will be irrelevant based upon whether or not they're differential. So we can say our general factory overhead, that is going to stay because it gets shifted to other product lines. So I'm going to say IR irrelevant. Salary of the product line manager. We're pretty ruthless, and what we're going to say here is if we get rid of the product line, we have to get rid of the manager. In reality, that's not always the case, but here that's what we're saying. Okay? Depreciation of old equipment. You can see that the key word here is old equipment, which means we probably can't get rid of it. That's what we're going to assume. We can't get rid of it. And so it's going to be a sunk cost. All right, so we're going to say that one is also irrelevant. Okay? And then finally, we can come over and continue on with our product line advertising. Our product line advertising of $100,000, it would not make sense for us to advertise for a product line that no longer exists. So I'm going to say that one we can get rid of, and since we can get rid of it, it's relevant. Rent on factory space, this one has 3 asterisks, and look down here, it's manufactured in its own facility, which means that if we get rid of this digital watch line, we don't have to pay rent on this factory anymore. Okay? So then we can say that's going to go away if we get rid of the digital watch line, so that's relevant. Then finally, we look at this last one, our general administrative expense. That's another allocated common cost. Now again, what we're saying is that because this is an allocated common cost, just like the library example, going to those different majors, if we get rid of this digital watch line, this $30,000 will get shifted to other watch lines. And so in that case, it's going to stay around at the company level. It's irrelevant. So then we come over here and we say, should the company retain? Are there a couple ways? First, are there any irrelevant costs? And what we did is we set our depreciation. So I'll write it down for you. We had our depreciation to summarize above. Depreciation. We had our general factory overhead. And then what we also had was our G&A costs right over here, G&A expenses. Those are the 3 that are going to be irrelevant. So when we look at approach 1 for solving this problem would be using incremental analysis. Okay, so this is kind of the shortcut way. So basically what we can say is if we save more in our fixed costs, if our fixed cost savings, if our cost savings is more than our lost contribution margin, then we should drop the line. If it's the other way around, if our lost contribution margin exceeds our cost savings, then we shouldn't drop the line. So let me explain that a little bit more. We look over here, we can see that if we drop this line, we're not going to have any more sales. We're not going to have any more variable manufacturing costs. We don't have any more shipping because we have nothing to ship. We have no more commissions. So these go away, and then this goes away. So that's $300,000 of contribution margin, which is sales minus variable costs that I lose. So I can come over here and say, all right, I'm losing my $300,000 in contribution margin. Then I can compare that to the costs that I can avoid. Basically, these are the costs that will go away. So if my cost savings are more than the contribution margin that I lose, then I save more in terms of cost than contribution margin. Maybe it's something I should do. On the other hand, if my contribution margin that I lose is more than my cost savings, it's not something I want to do. So we looked over here. Remember, we had our salary of $90,000. We had our advertising of our $100,000. Then we had our rent of $70,000. We add up all these, we get $260,000. Then we can take our $300,000 minus the $260,000, $40,000. So what we should say is, don't drop the line. So essentially, if we drop the line, we're going to lose more money by $40,000. So we'll lose $140,000 if we drop the line than if we keep the line. Okay? So that's what we're saying right over here. All right, let's take a look at the approach number 2, which is the other way to do it, which is to do comparative income statements, okay? And so I'm going to get you started on this, and then I want you to go ahead and pause the lecture video and complete it, okay? So if we come over here and we say we keep the digital watches, we have our $500,000 sales, and then if we drop it, we have zero, 500,000. And I just got this from the prior page showing our sales for our digital watch line. Then we have our variable expenses right over here, our manufacturing expenses. If you look in the prior page, 120. We had shipping of 5,000, and then we have commissions of 75,000, and of course those will all be zero. We had our total variable expenses right over here. That would be zero over here. So that gives us our 120. Okay. And then we lose out that 5,000. And then what we're also losing out is on that 75,000. And so then we can come over here. We have our 200,000. And so then we look at our lost contribution margin. If we have our contribution margin, we have our 300,000 right over there is our contribution margin. Total variable costs are 200. And then, of course, if we drop our watch line, we have zero contribution margin, which means we have our loss of our contribution margin. I'm going to go ahead and pause the lecture video, and what I want you to do is do this next page right over here where we go through the fixed expenses, which ones would stay and which ones would leave, okay? And then we'll come back and check it. Okay, so let's see how you did. And so what you should have said was we had our general factory overhead. If we keep the line, if we drop the line, we still have it. Salary of the product line, if we keep the line, pay the product manager. But if we drop it, we don't have to pay them, so then we have our difference. Depreciation, as we talked about earlier, it's an old equipment, it's a sunk cost. We'll keep that. Line advertising, we can get rid of. Rent on the factories, we can get rid of the factory. And then finally, our G&A expense we'll keep. So then what you have is the loss of 100,000 and then the loss of 140. If you drop the line, you should not drop the line. You should keep the line because you lose less money. Now, the right answer is not to keep losing money forever, but it is to do things, take some strategies to improve your profitability, perhaps maybe by looking over here at some of your manufacturing costs, looking at a new supplier, reducing your shipping or commissions, okay? In the next lecture video, we'll talk about make or buy decisions. Thank you.